Welcome to Chapter 16, Complex Financial Instruments. This chapter deals with complex financial instruments, and the learning objectives are listed here. We're going to talk about derivatives and why we use that term and how we use them to manage risk. We'll talk about accounting for derivative instruments. We'll talk about hybrid instruments, which combine two or more different kinds of financial instruments. Can represent a liability or an equity instrument or both. We'll talk about the accounting for those hybrid instruments. We'll talk about stock compensation plans and share-based compensation. We'll talk a little bit about differences in accounting between ASPE and IFRS for these two, these kinds of instruments, and what's happening in the future. So let's begin. Complex financial instruments. Complex financial instruments were once fairly uncommon, but they're now widely used by companies in an effort to manage risk, to access pools of financing, to minimize the cost of capital, minimize taxes. And in response to this trend, the accounting profession has developed a new framework for dealing with these instruments in the financial statements. So Chapter 16 focuses on those complex financial instruments, including derivatives, which are discussed separately from other financial instruments. Employee compensation plans often include the issuance of derivatives such as stock options, and so this topic is also discussed in the chapter. So financial instruments are contracts that create both a financial asset for one party and a financial liability or equity instrument for the other party. Financial instruments can be primary financial instruments, which would include most basic financial assets and financial liabilities such as receivables, payables, as well as equity instruments such as shares. Derivative instruments, on the other hand, are more complex. They derive their value from an underlying primary instrument, and derivatives are defined as financial instruments which create rights and obligations that have the effect of transferring between parties to the instrument one or more of the financial risks inherent in an underlying primary instrument. So they transfer risks that are inherent in the underlying primary instrument without the holder having to necessarily hold the underlying instrument. So they have three characteristics. One, their value changes in response to the underlying instrument. Two, they require little or no initial investment. And C, they're settled at a future date. So those are the key characteristics of derivatives. They'll show up here in a second. Now, in terms of the financial accounting standards, I guess I should put put Chapter 16. There we go. Now I have a title on my PowerPoint slide. So the relevant IFRS and ASPE sections are listed below here. Financial instruments, recognition and measurement is in section 3856 of ASPE, and financial instruments presentation and hedging are both considered there. And stock-based compensation or payments is considered in section 3870 in ASPE. IFRS 9 covers recognition and measurement of financial instruments. IAS 32 considers their presentation. IFRS 9 also covers hedging, and IFRS 7 talks about stock-based compensation payments. So if you need to look them up, that's where you would find them. So as I was saying, derivatives are financial instruments that have these three main characteristics. There's an underlying asset or an underlying instrument that drives their value. They themselves require relatively little investment. So if you have a call option on stock, you pay a small premium in order to get the right to buy stock for a particular striking price. So the underlying instrument then would be the stock. The investment required would be the premium paid for the option, and the determination of whether or not the option will be exercised will happen at a future date, at the exercise date. European options have an exercise date at the very end of the maturity, so you have to determine at that time whether you will exercise it or not. American style options are the ones that allow you to pursue to exercise your option at any time. And the theory says that American options in general will be exercised at the end of the maturity date anyway, because that's when they'll maximize their value. The use of derivatives there's a couple of reasons to use derivatives. Well, before we get there, let's talk about the kinds of instruments that would be included in derivatives. Options are the right but not the obligation to either buy or sell a particular underlying instrument at a particular time for a particular price. So an example would be a call option. A call option is the right to buy at a certain price. So the stock then is the underlying instrument, and if the share price goes up, the option is worth more. If the share price goes down, the option may become out of the money or worthless. So derivatives are used to manage several kinds of financial risks, such as credit risk, which is the risk that one of the parties to the contract will fail to fulfill its obligation under the contract. And that would cause the other party to lose money. For example, credit risk is often associated with the collection of an amount owing. Liquidity risk is the risk that the company itself will not be able to honor the contract and fulfill its obligation. The more debt that a company has, the greater the risk that it will not be able to repay its debt, and the higher the liquidity risk. Market risk is also covered. That may be the primary thing that you think about when you think about derivatives and options. The risk that the fair value or future cash flows of a financial instrument will fluctuate because of changes in market prices. So currency risk, your local currency may fluctuate in its value according to a comparison currency. In Canada, the big one, of course, is the US dollar, so the Canadian dollar and the US dollar. Change in interest rates can be minimized. The risk of the interest rate risk associated with change in interest rate can be minimized with derivative securities or other capital market forces, such as market price risk, the price going up or going down depending on which side of the contract you're holding. Now, derivatives are used by a number of different for a number of different purposes. They're used by producers and consumers to lock in future revenues or future costs, so you can establish the price now for what you're selling at some time or delivering sometime in the future. For consumers or users or purchasers, customers, you can lock in the cost today in terms of a currency value that's established today, and so you don't need to worry about the foreign exchange risk changing the price when you actually receive the delivery. Speculators and arbitrageurs also use derivatives, but they use them more to generate profit from trading those securities. They're not interested in the underlying asset. They're interested in the change in price during the time that it is held. And the speculators and arbitrageurs are the ones that actually provide the market. So to some degree, they have a role in maintaining the liquidity of the market. There may be other motivations to use derivatives. Management may want to reduce the amount of interest rate volatility, especially if they have a lot of debt outstanding. They may want to manage volatility in their foreign exchange transactions as well. So you want to be able to predict it in advance and know what your price actually will be, so that you can actually model your production function to meet that price. So there's some management motivations as well as motivations by producers and speculators. Producers a common example, I suppose, in our context would be farmers and setting a future price for their production at the beginning of the growth season, as opposed to waiting and selling at the spot rate when it was done. Okay, so accounting for derivatives. A few of the things that we should talk about, we've talked about before. In 353, we've talked about executory contracts, and so derivatives are very similar to executory contracts, and so in some situations you can actually use derivatives. You can view derivatives as executory contracts. So, for example, non-financial derivatives. Derivatives can be either financial or non-financial derivatives. In a contract to buy, say, pork bellies, we've talked about pork bellies. Pork bellies is essentially cooking oil, right, in its unrendered form. So a contract to buy pork bellies is an example of a non-financial liability, and so it's a commitment to purchase that product, those commodities, pork bellies, at a particular price at a particular time in the future. And so essentially purchase commitments are executory contracts. So they establish what the price will be at some time in the future, and we actually have to deliver the pork bellies or fulfill the terms of the contract in some way in the future. So derivatives are essentially contracts to do something in the future, and so you could arguably refer to them as executory contracts. And so in that requirement, the fact that we are promising to do something in the future, the two are similar, but the purchase commitments are not structured as derivatives contracts from a legal perspective, and so they don't trade on commodities exchanges, whereas a lot of the derivatives, the financial derivatives do trade on commodities exchanges. So derivatives are different from purchase contracts in that they actually are traded on commodities exchanges. So under ASPE, purchase commitments and other commodities contracts are not accounted for as derivatives unless they are actually exchange traded. They're traded on an exchange somewhere. And that's partly due to the fact that it's difficult to measure when it's a one-off contract or a contract between unrelated parties, arm's length parties. So they're not actually recognized in the financial statements until the goods are received, so the price is established at that time in the future. IFRS, however, considers whether contracts have a net settlement feature, meaning can they be settled on a net basis by paying cash or other assets as opposed to taking actual delivery of the underlying product. So for contracts with those net settlement features where you can just pay a cash price, as long as the company intends to take delivery of the raw materials, the contracts are designated as expected use and are not accounted as derivatives. They're accounted as executory contracts or purchase contracts. And remember, the key issue of executory contracts was that if it's essentially a contingency situation where you may actually have locked yourself into a position where the transactions will result in a loss in the future. So in that case, you would record the prudent accounting would say that you record that loss earlier as opposed to later. So the contracts are designated if the company is actually planning to take delivery of the raw materials. Under IFRS, the contracts are designated as expected use, and they wouldn't be accounted for as derivative contracts. They would be treated like the other executory contracts that we've talked about. So purchase contracts that must be settled by taking delivery or delivering the underlying products are not accounted for as dividends. As such, they're not recognized until delivery of the underlying non-financial asset, unless, of course, they are in terms that would require a transaction at a loss. So, other kinds of derivative securities would include options, forwards, and futures. And so, an option is something that gives the holder the right to acquire at a certain price, or the right to buy at a certain price, or the right to sell would be a put option. So if you have you have the right to buy, then you are the owner of the option. If you give someone else the right to buy, and you're obligated to fulfill the other side of the contract, you're the writer of the option. You have an obligation. If you're the purchaser of the option, you have the option to exercise it or not to. A call option is the right to buy. The right to sell is a put option, so you can think of it as putting it out for sale or calling it in for purchase. So the call option contract or the put option contract would specify a fixed exercise price within a defined exercise period. So there's a time period at which the option would expire. The stock option derives its value from the share price of the underlying shares. So if we're talking about stock as the underlying instrument, that's the sort of most common, the most, I guess, suppose easily understood kind of option. So it allows the holder to participate in the share value without actually holding the share. So you can take a position and control a certain number of shares without actually owning the shares themselves. So the investment isn't as high as if the shares themselves had been purchased. So you can control a large position without actually having to buy them, which is the reason you would enter into an option contract. So you can actually view the option premium that you have to pay to get into an option contract as two parts. There's an intrinsic value, which is whether or not the option is in the money. If it's in the money, there's an implicit or intrinsic value. For example, in a call option, you have the right to buy at a certain price. If the price goes up, then the value of the share on the market minus the exercise price would be the profit that you could get by exercising the option. So you buy at the exercise price and then sell immediately on the market, and you make a profit, and that would be the intrinsic value. But there's also a time value, because the delay till exercise increases the possibility or probability that the stock option would be further in the money, or if it's not in the money now, it could move into the money. And so that's the time value. It's the option's value over and above the intrinsic value, and that reflects the possibility that the option will finish with a fair value greater than zero. So there's some expectation that the price of the underlying shares would increase above the stock price during the option term, even if they're out of the money right now. So a gain or loss is recognized when there's a change in the value of the option. So whenever you've got a measurement date, you would need to recast the value of the option at that time and record any gain or loss. A forward contract is somewhat different from an option. In a forward contract, the parties to the contract each commit up front to do something in the future. So they actually promise to do a transaction in the future. So one party will buy, the other will sell the underlying at a certain fixed price at a certain date. A forward contract is different from an option contract in that it not only transfers to the holder the rights to increases in value, but it also creates an obligation to pay. So you would lose if there was a decrease in value. So it also creates an obligation to pay a fixed amount at a certain date. So you have the right to participate in increases in value, but you also have an obligation to pay a certain amount in the future. The purchased option, on the other hand, creates a right but not an obligation. So an option is protecting against sort of downside risk, but you can still participate in the upside if the share moves in a way that increases your profit. So the holder may choose to exercise the option, but need not. If you're the writer of the option, of course, then it's an obligation for you. So the accounting, the basic principle of accounting for derivatives, financial instruments, including financial derivatives, and some kinds of non-financial derivatives that meet the definition of assets or liabilities, which we have learned earlier, should be reported in the financial statements when the entity becomes party to the contract. So when you actually have created an asset or created a liability, it should be reported in the financial statements. Derivatives should be reported at their fair value. So that would be the value, the intrinsic value plus time value for an option. Gains and losses should be actually recorded through net income because you've earned them even though you haven't realized them in cash. And there is some special accounting required for items that have been designated as being part of a hedging relationship. That's covered in Appendix 16A, and we probably will not cover that in this course. So an example of a non-financial derivative would be a contract to buy steel at a specified date for a specified price. So you're talking about the underlying instrument being a commodity that you would actually use in your business. So this would be an example of a purchase commitment, an executory contract. Um, so is that actually a derivative? Well, its value does change with the value of the underlying asset. There's little or no investment upfront, and it is settled in the future. So it meets the definition of the derivative which we saw before. And so under IFRS, purchase commitments are not treated as derivatives, and they're recognized when goods are received if there are no net settlement features. So if you can settle them for cash, then they're essentially, even though they cover a non-financial good, they're essentially settlable in financial terms. So you can settle for cash or other assets. It's recognized when goods are received if there are no net settlement features. So if you can't settle them in cash, if you actually have to deliver the goods or take delivery of the goods, they would not be treated as a derivative. Or if there are net settlement features, but the company intends to take delivery and so designates the contracts as expected use contracts. So they've basically said that they're looking at the value and the use of the goods that they either will receive or have to deliver. Under ASPE, they're never accounted for as derivatives because of the difficulty in measuring it, but the delivery of the goods, the cost of the goods would be recognized when the goods are actually received. Okay, so call options are the right but not the obligation to buy the underlying at a preset price. A put option is the right to sell but not the obligation to sell. So if you are the holder, you have the right but not the obligation to transact. So you'd only do it if it's in the money. So you can be the writer or the purchaser of a call or put option. If you have written the call option, that gives you the obligation to sell for the striking price. And so you transfer the rights to buy the shares or other underlying instrument for a certain specified price. And of course, you'll have to take the loss if the price goes up. If you purchase a call option, it gives you the right to buy at the striking price. So you would pay a premium for the option. The writer would sell the option for a premium. They would receive the premium. And the purchaser would have the right to buy the shares or underlying instrument at the exercise price at some time before the expiry of the option. The put gives you exactly the opposite case. So if you're the writer of the put, you get a premium for selling the option, and you are obligated to purchase the underlying shares or underlying assets from the holder of the option if they choose to exercise it. The purchaser pays the premium and then obtains the right to sell if the option is in the money. Of course, the call you make money by, as the holder of the option, you make money by the price going up. The put, you make money if the price goes down. So here we have an option example. We have a call option which is entered into January the 2nd, and it expires April the 30th, so you have to exercise it before then. If you don't, then it will expire unused. So you have an option to purchase 1,000 shares at $100 per share. On the date that the option is entered into, that is equal to the price on the market. So there, it's at the money. It's neither in nor out of the money. You can't make any money by buying it for $100 and selling it for $100. So the option has no intrinsic value, but it does have some time value because between January 2nd and April 30th, there's a high probability that the price of the shares might move up, and you can still buy them for $100 even if the price has gone higher. So you pay, the option is purchased for $400, which is the option premium. So you are allowed to control 1,000 shares, which would cost you $100,000 if you actually bought the shares, but you're controlling them with a $400 premium. So the share price on March 31st goes up to $120 per share, so it's $20 in the money. So you've made $20,000 essentially on your shares. So you can buy them for $100 and sell them for $120 on the market. There may be a transaction cost to sell them on the market, but still $20,000 is quite a nice profit over a couple of months. I suppose it's 3 months. So the option trades at 20,100 on March the 31st, and you actually settle the option in cash on April the 1st, 2017. And so we're assuming March 31st is the end of the fiscal period, and so we need to prepare the journal entries to record these transactions. So the option price has two pieces. The option price, the value of the option has two pieces: the intrinsic value, which is 0 at the time of issue, and there's a time value which represents the $400 because there's no intrinsic value. The time value is everything that's not the intrinsic value. So $400 at the time of issue is the premium that you pay. That's essentially all time value because the option is not in the money at its delivery or at its initiation. So on January the 2nd, the acquisition date, you would record the fact that you have paid for some derivatives. So you are the purchaser of the option. You record the derivative as an asset. It does meet the definition of a financial asset because it has a specific number of monetary units, and it is an economic resource that is under the control of you as the owner, and it will provide you a future benefit, and it's a result of a past transaction. So you've paid cash, you have the derivative. So you record a debit to the derivative, record the cash payment. On March the 31st, the value of your derivative has changed to 20,100. That's what it's trading at. So you would record a gain. The price has gone from $400 up to 19,700, largely because it's moved into the money, and you could earn $20,000 by buying the option and or buying the shares with the option and then selling them on the market for $120. So you pay $100 to buy the shares, you get to sell them for $120 on the market. And there are 1,000 shares, that's $20,000. So on April the 1st, so that would be the March 31st, you would record that because it's presumably the end of the year, and so you need to record it as the correct value at the end of the year. The market value has gone up. You need to record that increase in value. So with these two transactions, your derivatives would be shown at 20,100, which is what they're trading for. You would reduce cash and you would show a gain in your income statement for $19,700. Then when you actually settle it the next day, you would have to choose to exercise your option, and so as a result your derivatives would be gone, and the derivatives would be I'm not sure why they changed the title here, but the derivatives of the financial assets would be gone because you've gotten rid of them. You get cash because you essentially make $20,000 by issuing exercising your options. So you buy 1,000 shares for $100 and you sell them for $120 on the market. So $120,000 is what you would get. The net cash would be the $20,000. However, the value of your derivatives on your financial records would be $20,100, so that would result in a slight loss. $20,100 derivative value would have been settled for $20,000, so you lost $100. Forward contracts, as we said, a forward contract has two parties, and it actually commits both the parties to engage in a transaction in the future. So they'll actually have to exchange something at the future date. So a forward contract, there are two parties to the contract. A future contract is a standardized contract. We'll talk about that in a bit. But forward contracts are between two transacting parties. They may be mediated through some kind of a financial institution, but it requires them to actually settle the obligation. So the forward contract would establish the price and the time period for the forward contract under the contract, and they generally don't trade on exchanges because they're between two transacting parties. Banks and other financial institutions are often involved in forward contracts, and they may provide security to minimize credit risk and those sorts of things. Forwards essentially are measured at the present value of the future cash flows. So you would discount the cash flows to today's value, and that would be the value of the forward. And the discount rate would be a rate that reflects the riskiness of the transaction. So an example would be on January the 2nd, Abalone agrees to buy $1,000 in U.S. currency for $1,150 in Canadian currency, and that transaction will happen in 30 days, and they buy the forward contract from Bond Bank. So Bond Bank and Abalone are the parties to this transaction. Abalone has the right to any increases in the value of the underlying U.S. dollars. So they have the right to buy 1,000 U.S. dollars for the price of $1,150 Canadian. And so if the price, the exchange rate, the U.S. dollars per Canadian dollar goes up, that means that you are able to buy a high value U.S. currency for a fixed Canadian price. So the obligation exists to pay a fixed amount of $1,150 anytime, anytime the price goes up between now and the settlement date, at the end of the contract in 30 days. That's an increase in value, that's a gain. If the US dollar price goes down, that would be a loss. So this forward contract is designed to transfer currency risk. So Abalone is perhaps expecting to have to make a payment in US currency 30 days from now, and they want to establish the price today, because if the US currency goes up in value, they'll have to pay more to settle their obligation in the future. So they're establishing the price today in the Canada-US dollar exchange rate. So at inception, the value of the contract is 0. So they haven't actually done anything yet. There's no past transaction to reflect an asset value, so they haven't created an asset value. But as soon as the value of the forward contract changes, then that does record either an asset or an obligation, a gain or a loss. So the value of the forward contract varies depending on the interest rate as well as the spot rate. So there's a few things that are going on. Whatever the underlying currency exchange rate does will affect the value of the forward contract. It also is 30 days into the future, so the interest rate that's applicable is important to know as well. So if the US dollar appreciates in value, then we're actually gaining, because that means that when we make the payment, we're only going to have to pay $1,150 Canadian. If we were to buy the US dollars at the spot, if the price has gone up, we'll have to pay more than that. So in this case, the forward is remeasured at its fair value at the time that the value changes. So for example, if the fair value of the contract is $50 on January 5th, 2017, you would record a journal entry to record an asset, a financial asset, $50, and a gain on value. So when you actually make the transaction, you will pay $1,150 for something that's worth presumably $1,200. If the US dollar declines in value, then that's creating a loss, because we have to settle the contract, so we actually have to pay $1,150 to get 1,000 US dollars. We could buy it more cheaply on the market, which is why it's a loss. So the journal entry to record the loss would undo the gain. So if we had a $50 increase in value and then a $50 decrease in value, the gain would be undone, and you would end up in a loss position. So if on January the 31st, the fair value of the contract is a loss of $30, then we would have to record a loss because we'd previously recorded a gain of $50. The value of the derivative, the financial asset, becomes essentially a liability now, because we have to pay extra for something that's worth less than what we're paying for it. So forward contracts can be settled on a net basis in cash. So if we assume that on the settlement date on February the 1st, the US dollar is worth $1.05, and we've promised to pay $1.15 for it, then we actually have a loss of 70. So we would pay cash of $100, so our $1,000 US times the $1.15 we agreed to pay minus the $1.05 which it's worth today. So we've agreed to pay 1,150, and we get US dollars which we could sell for $1.05 today. So that gives us the $100 of cash. The loss of $70 is the loss that we recorded in the previous journal entry. So we have a loss of 80. Sorry, I'm give me a second to figure out what's happening here. So there's an additional. All right, so we started with the first one was a gain of 50. Then we brought it back to a loss position of 30 with our debit to a loss of 80. So the net of those two is a loss position of 30. We actually lost $100 by the time we were done, so there's an additional loss that we have to record at 70, and the balancing figure is to reduce the derivatives, and they would be completely off the books now because they would be valued at a value of 0. So on the cash basis, there would be two cash payments. You would have to pay $1,150 to settle your obligation under the forward contract, and that you would receive cash of $1,000 US, and that cash would be valued at $1,050. So when you used it for whatever purpose you set the forward contract in place, the value would be a reduction in cash of $1,050, and that would be the $100 which we saw here. So if we actually settled the contract and paid it out, that would be the loss of $100. Futures contracts are another kind of derivative contract, and they're a lot like forward contracts, except they have a standard form, and so they are standardized and they trade on stock markets and exchanges. So there's a ready market value, and they have standardized size of contracts. So there's sort of a standard block of whatever it is you're interested in trading. There's it'd be maybe 100 shares or $1,000 or something like that. There's standardized terms. So you would purchase a certain number of contracts in order to fulfill whatever your derivative objective was. They're actually exchange traded, so they are settled through clearing houses, and so the clearinghouse takes out the credit risk. As part of the transaction, the clearinghouse would have to establish a margin account, so you actually have to set up a partial purchase with a margin account. You have to have enough money in the margin account to cover the transaction, given your riskiness in your relationship with your broker. The margin account, you'd have to top up the margin account if the value of the futures contract goes against you. You would have to top it up. So it's essentially a percentage of the value of the contract that you have to maintain in a bank account available to the clearinghouse. So there's essentially a premium for them to take the credit risk in that situation. So futures example: forward entered into a future contract to sell grain for $1,000, presumably some kind of standard lot of grain, and the initial margin of $100 cash is required. So you have to pay $100 to enter into this futures. You have to actually have that in your margin account with the broker, the clearinghouse, and it's a non-financial derivative because the underlying commodity is grain, and that's not financial. So currency risk would be dollar bills would be a financial commodity. Grain, pork bellies, those sorts of things would be a non-financial derivative. So we're going to record the journal entries for this contract. The contract is valued at 0 at inception, just like a future, the forward contract was, because you haven't actually taken a position, you haven't transacted anything, so there's no past economic transaction. But you did actually pay $100 into the margin account. So you would take it out of cash and put it into a deposit account or a margin account or something like that. So we're going to call it deposits. And the value of the grain, if the value of the grain increases after the contract date, the value of the contract goes up. So you actually have we're going to sell grain for $1,000. So we've established a contract now. We could have sold it for a higher value if we had not had this contract in place. So therefore we've lost money. We've lost the potential of getting more. We still have to, we have the obligation to deliver the grain at that lower value. So that creates a financial liability. So the derivative would be valued at $50 liability, and the loss would be recorded at 50. And if we had to increase the margin, we would have to record that as a deposit, an increase in the deposit as well. So if the contract is actually closed out on a net basis, there's no actual delivery of grain, then the journal entry would be reducing cash by $100 because it costs us $100. Back up here. The deposit amount is $150 now, and so we would have gotten $100 back. Our deposit would have been gone, and we would have to recognize the loss through a lowered amount in our return from the margin account. So the loss on the contract was recorded in the previous journal entries. So just the settlement here, there's no loss induced by this transaction. So the loss was already recorded as a derivative liability. The liability has been settled in this journal entry. Now, we can actually enter into derivative with our own shares if we have a corporation. So we could actually either purchase options or write them for our own shares. We can also enter into forward contracts to buy our own shares or sell our own shares. And so, of course, that creates a bit of a presentation issue because we're creating an obligation in our own equity. And of course, that's one of the things that got Enron in a lot of trouble, is because they were trading in their own equity. So, under IFRS, any contracts that are for a fixed number of shares for a fixed amount are generally presented as equity. So a fixed for fixed is the principle. So if you have a fixed amount of fixed number of shares for a fixed amount, then you've essentially, the only thing that you have to do is collect on the obligation. So you've established the obligation, the asset or liability at the time of the transaction. So you would record it as equity. And all you have to do is settle the account. So generally there are two exceptions to this rule. If the derivative creates an obligation to settle in cash or other assets, then it's not fixed shares for a fixed value. There may be a gain or loss, so the amount that you're actually going to receive as equity would not be established up front. So if the derivative creates an obligation to settle in cash or other assets, or if the derivative allows a choice in how the instrument is settled, then it doesn't meet the fixed for fixed principle. ASPE doesn't deal with this, but the same principles would support equity presentation. So ASPE would allow you to record the transaction when it's actually settled, whereas IFRS says the creation of a fixed for fixed obligation would be recorded as equity at the time that agreement was established. In your textbook, illustration 16-5 talks about the details of the derivatives involving your issuing your own shares. And so if you've written call options, they're treated as equity because the holder has the right to buy a fixed number of shares for a fixed amount of cash. And so it's a fixed for fixed, and there's no contractual obligation to pay cash. You have agreed to issue a certain fixed amount of shares, fixed number of shares for a fixed payment. So it establishes the equity value at the time of the writing of the call option. A written put option is a financial liability because the holder has the right to sell a fixed amount of shares to the company for a fixed amount of cash, and even though this is a fixed for fixed contract, the obligation to pay cash creates a liability. So they would have to have their own shares. They would have to purchase the shares on the market, and then they have the right to sell those shares to you back to the company for a fixed amount of cash. So that's a financial liability. It's not an equity instrument. The treasury share section, which is, I believe it's chapter 16, chapter 15, talked about treasury shares in one of the appendices. If you purchase a call or put option, then it would be treated as a contra equity account, because the company has the right to buy or sell a fixed amount of shares for a fixed amount of cash, and there's no contractual obligation to pay cash. So in this case, it's an equity. It would require equity treatment because it's fixed for fixed, and there's no obligation to pay cash because you are the holder of the option. It's your right, not your obligation. Forward contracts, of course, are a promise to actually fulfill the transaction. So the company is committed to buy. If they set a forward contract to buy shares, then the company has committed to buy a fixed number of shares for a fixed amount of cash. And even though it's fixed for fixed, the obligation to pay cash means it's a financial liability. So forward contract to buy shares would be a financial liability. Forward contract to sell shares would be equity. The company is essentially selling equity. The company is committed to sell a fixed number of shares for a fixed amount of cash, and there's no contractual obligation to pay cash, so it's therefore an equity treatment. Contracts that may or will be settled as a net settlement, so they have the net settlement option, are treated as either financial assets or liabilities because they're not fixed for fixed contracts. They'll be settled either in cash or a variable number of shares equal to the net cash settlement value. So in that case, there's a financial asset or liability. That, as I said, is found in your textbook, illustration 16-5. Okay, so now we move on to hybrid or compound financial instruments. And compound financial instruments have attributes of both equity and debt. So they're referred to as hybrid or compound instruments because they have two different attributes, both equity and debt, in the same instrument. So with these instruments, the main accounting complexity lies in determining how to classify them on the balance sheet. So users rely on the classification between debt and equity to assess the company's liquidity and solvency, so it's an important issue. So the classification issue is a significant one. As these types of complex instruments proliferate, and they are becoming more common, financial statement preparers and analysts are faced with the increasingly difficult task of classifying instruments that don't fit neatly into either debt or equity. So they have characteristics of both debt and equity. For example, convertible debt would allow you to convert your bond into a certain number of common shares. So the common shares, of course, are equity. The bond is a debt instrument. You can have debt with detachable warrants, and warrants allow you to buy common shares for a certain price. So it's essentially like a call option attached to the debt instrument. So to determine the appropriate presentation, you need to think about what the contractual terms say. Does the instrument explicitly obligate the entity to pay out cash or other assets? If so, it's an obligation, it's a liability. Does the instrument give the holder the choice to force the company to pay out cash? In which case it would be creating an obligation for the entity. Or are there settlement options? So in that case it may, not necessarily, but it may create an obligation for the entity. So the contractual terms, the specific contractual terms need to be considered. The economic substance. So does the instrument actually contain any equity-like features that may need to be measured separately? So convertible bonds have an equity-like feature. They can be converted into equity bonds. It's basically a call option attached to the convertible bond, sort of attached to the plain vanilla bond. So there's an equity instrument, as we just discussed. A call option on your own equity would essentially be an equity treatment. An equity treatment would be required. The definitions of financial statement items or financial statement elements. Remember, a financial liability is defined under both IFRS and ASPE as a contractual obligation to do either one of the following: to deliver cash or another financial asset to another party, or to exchange financial instruments with another party under conditions that are potentially unfavorable. So the obligation The financial liability is a contractual obligation to do one of those things. So under IFRS, using an entity's shares instead of cash to settle an instrument is still a financial liability. An equity instrument under both IFRS and ASPE, as we have seen in the past. An equity instrument is any contract that evidences a residual interest in the assets of an entity after deducting all of its liabilities. So essentially, if you have a right to participate in the liquidation of the assets after all of its liabilities have been paid, that's an equity instrument. So under IFRS, an equity instrument exists as well if it will be settled. Let me try this again. Under IFRS, an equity instrument exists as well if it will be settled by exchanging a fixed number of the issuer's own equity instruments for a fixed amount of cash. So if it satisfies the fixed for fixed principle, then it would be an equity instrument. So some examples of hybrid or compound instruments show up here shortly. So sorry, I should have moved my slide forward here. The financial liability, the definition is shown here, and under IFRS it would be consistent with this, but it's not necessarily part of the definition. So IFRS would explicitly include instruments using a variable number of shares as a financial liability. Under the second definition, you would have to exchange your shares for a potentially unfavorable price. You could issue them at the market value for higher value. So that's potentially unfavorable. Okay, so as I said, illustration 16-5 talks about the treatment for writing options or put options, or writing or purchasing options and forward contracts. So illustration 16-7, just a little bit further along, talks about specific examples of equity instruments. And so see that illustration in your textbook. So in terms of the examples of hybrid, I thought we had a list of examples here shortly, and I'm not seeing those, so let me just list them quickly for you. Convertible debt would be an example we've talked about. Puttable shares. Puttable shares are shares that the owner has the right to sell back to the company, which is essentially the same as we've talked about before. That would be a financial liability on the books of the company that has issued the puttable shares. So essentially there's a put option attached to the shares. They have the right to exercise the option, and it's beyond the entity's control, so therefore it's an obligation. Any shares that give the holder the option to require the company to surrender a pro rata share of net assets upon windup. So if you have an obligation for a certain share of the assets on liquidation, then it would be presented, and maybe the common term is on substance common shares. So even though they're not actually common shares, they may be presented as equity as long as there are on substance common shares. So essentially you have a common share interest even though you don't have officially registered common shares. Mandatorily redeemable preferred shares. So these are shares that meet the definition of a liability, since there's an obligation for the company to pay cash to redeem the shares from the purchaser. So when the term expires, the company is obligated to buy back the shares from the shareholder. So essentially they're saying that that's a debt obligation because you have an obligation to pay cash to buy it back. If you have debt with detachable stock warrants, the warrants give the right to buy common shares at a fixed price. So it's essentially like a call option. And because a market often exists to buy and sell these instruments, the warranties are equity instruments, and therefore the instrument is part debt and part equity, and the proceeds of the sale of debt with detachable stock warrants would be allocated between the two securities. We'll deal with that a little bit later. There's two methods, the residual value and the net fair value methods. Preferred shares that must be repaid if certain conditions are met would be similar to the puttable shares or the mandatorily redeemable preferred shares. Debt that will be settled by issuing a variable number of common shares based on the price the face value of the debt and the price of the shares on that date would be a liability. Again, it's a potentially unfavorable outcome. Perpetual debt would be debt that's never repaid, which makes it similar to equity. So it's essentially you're going to continue paying interest, but you never actually have to pay the debt back. So since it's perpetual, the interest over time essentially becomes it essentially becomes the time value of the future interest obligation becomes less and less and less important. So as time passes, the interest, as you're paying interest over time, the perpetual bond's value is driven solely by the obligation to pay interest. And so because you're obligated to pay cash, it's a liability. So even though it's perpetual debt, even though it's very similar to a preferred share, because you have an obligation to pay interest as cash, that's an obligation. It's classified as a liability. You can offset financial instruments if you have a legally enforceable right to net the amount. So if you've got one financial asset and an offsetting financial liability, then you have if you have the legally enforceable right to net the amounts against each other, and the company intends to settle the instruments on a net basis, then you could offset them and show them as a net asset or net liability position. If you don't actually have that legally enforceable right, you would have to show them as individual assets and liabilities. Okay. Now, measurement issues. As I promised you, we are going to talk about the measurement of hybrid or compound instruments. There are two general approaches. There's a residual value method, and there's a relative fair value method. So it depends on the objectivity or the reliability of the underlying measures of value. So measurement of hybrid financial instruments may be made more complicated when the economic value is attributable to both debt and equity components. So you could use either the residual method or the relative fair value method, and these tools are used to allocate the value between the debt and the equity components. Relative fair value, you would determine the fair value of similar straight debt obligations if you can find a market for that. So if there's a market value for example, bonds which have a particular bond rating, you'd be able to determine comparable bonds and what their price would be. So if you can actually find some plain vanilla straight debt obligations with no warrants, and your debt obligation has the same characteristics with an addition of warrants, then the straight debt from the other market value would be used to value the debt, and then whatever is left over would be the value associated with the options or warrants. So measurement of the debt portion could also be done on a present value calculation. If you could identify the market rate for similar kinds of debt, or if you've got a bank loan under similar terms, and the market rate or the rate that's demanded by the bank institution would establish the discount rate for you. In which case you would establish the value of the debt, and the warrant would be whatever's left. So the components are assigned the values depending on the most reliable measure. So if there's a liquid market or there's an external valuation option that provides you with a good, sound, objective, reliable basis for valuing part of the transaction, the rest of the transaction could be just the rest. So that's what the residual value does. Or the relative fair value method. If you can establish the fair value for the debt and the fair value of the warrants, you would prorate the price that was actually paid based on a pro rata proportional allocation. The residual method is the one where you can value one component and the other is the leftover. So residual value refers to establishing a good value or reliable value, and then whatever is less reliable would be the leftovers. Relative fair value would be if you identify fairly reliable values but they're different from the actual price that was paid, you would allocate them on a proportional basis. So IFRS uses the residual method, with debt being valued first because that's the one that has primary status in liquidation and in obligation of the company. So IFRS uses the residual method. ASPE allows either one. It even allows the equity component to be valued at zero and the entire amount to be allocated to debt, and so any actual realization of equity later would be adjusted with a gain or loss. But it does allow the use of the residual method with the component that's easier to measure being valued first. Convertible debt. A convertible bond is one that allows you to convert the debt into something else, and it's usually common shares. So it combines the benefits of the bond with the privilege of exchanging it for common shares at the holder's option. So they have the right to convert it to common shares. Corporations issue convertible debt for two main reasons. One is they want to raise equity capital without giving up more ownership control than is necessary. And so as long as they can continue to pay the debt obligation, they don't have to dilute their ownership interest. The other is to obtain debt financing at a cheaper rate because of the convertible bond. The conversion privilege would allow you to sell the bonds for a higher price, a lower interest rate. So the embedded option to convert to common shares is an equity instrument, and so that part of the instrument is presented as equity. The remaining component of the bond is presented as a liability. So in terms of accounting, when bonds are converted prior to maturity, we use the book value method of recording the bond conversion, and that's the method that's most commonly used in practice, even though there's no gap that specifically says how we measure the transaction. The book value method indicates that the transaction should be measured in accordance with the agreement that was established at the date of the issuance, either to pay a stated amount of cash at maturity or to issue a stated number of shares of equity securities. So when the debt is converted to equity in accordance with the pre-existing contract terms, there's no gain or loss because you're just exchanging book value of one form for book value of another form. So under the book value method, the unamortized portion of any discount or premium would be reversed. Bonds payable, contributed surplus, conversion rights would be zeroed out. Any related accounts for the bonds which had been converted would go away, and you would end up with a replacement value in the equity. So any difference represents the value of the shares issued in the transaction. There is an alternative approach that has some conceptual merit. It uses the fair value to record the transaction. So under this method, the common shares would be recorded at their fair value, and the contributed surplus account, bonds payable and unamortized discount or premium would be zeroed out, and there would be a gain or loss to represent the fact that you had issued those shares at either a premium or a discount over what they were at the time that you entered into the convertible bond contract. So sometimes the company may actually wish to induce conversion of outstanding bonds in order to keep their interest expense down, or for some other reason to improve the debt equity ratio. So they may actually pay an additional cash inducement, sometimes called a sweetener, to prompt the conversion of the shares, and that additional premium should be allocated between the debt and equity components based on their fair values at the time of the transaction. We'll see how that worked with an example shortly. So, bonds that are convertible to other forms of securities are convertible debt. It combines the benefits of a bond with the privilege, the risk reduction of having the potential of getting shares. And it's the bondholder's option, not the company's option. The company is essentially the writer of the option in this case. Once the bond is converted, all the interest and principal are no longer payable. They have shares in the company. So the reasons for issuing that is raising equity capital without giving up control, unless it actually becomes profitable for the debt holders to do that. And it could also reduce the costs, reduce the interest costs, because it's less risky for the holder of the bond. So we need to talk about the reporting at the time of issuance, the time of conversion, and the time of retirement. So we'll look at the example here. So we have a 3-year $1 million par value, 6% interest convertible bond. So the 6% is the coupon. Similar bonds without the conversion feature have a 9% interest rate. So that's the essentially the yield, the market yield. And so each $1,000 bond is convertible to 250 common shares. The current price of those shares is $3. So 3 times 250 is 750. So it's worth $1 million. It's worth each bond, each individual $1,000 bond is worth $1,000 as a bond. It would only be worth 750 as common shares. So at this time, there's no incentive to convert. So what portion of the proceeds from selling this bond are allocated to bond liability, and what portion is allocated to equity? Well, if the obligation, the coupon payment was priced with a 9% interest rate, that would represent the price of the bond, and any difference would be represented by the only difference, which is the conversion privilege. So the total proceeds at par would be $1 million, and the fair value of the liability without the conversion option at 9% is $924,061, which presumably, if we pull out the financial calculator, which I'm sure you all have, and it's a $1 million par value, so put $1 million into the future value, and they're 6% coupons, so 6% times $1 million would be $60,000. That would be the payment amount, and it's the same sign as the future value, and it's for 3 years, so 3 is N, and the relevant interest rate is 9, so we put that into I per Y. That's the market's required rate of return, and we'll compute the present value. Works out to 924,061, 924,061. So that's just the present value of the coupon payments of 60,000 and the fair value, the face value, the par value of the bond at $1 million to be received 3 years from now. So the value of the option is the difference between those two. The bond is worth $924,000. The rest of the $1 million would be $75,939. So when we issued the bonds, we got $1 million. $924,000 is the debt. The rest is the conversion rights. So let's imagine that we actually saw a conversion happen. So conversion before maturity, we'll assume that the unamortized portion of the bond premium would be $14,058. Is that a bond premium? Actually, it's a bond discount, isn't it? Because it's going up from below. So the book value of the bonds payable, the unamortized portion of the bond discount is $14,058 at the time that the conversion happens. So the bonds payable with the $1 million face value, the $14,058 discount results in a bonds payable value of $985,942. That goes away. So we have to reduce our bonds payable for $985,000, debit it to make it go away. Then we have contributed surplus conversion rights, which is $75,939, which should just be the number that we set up here. So we've got contributed surplus conversion rights, basically the option to convert. That goes away as well because they've actually exercised the conversion rights. And now we have common shares, 1,061,881, which is just the book value approach. The book value of the bonds and the book value of the conversion rights goes away, and we replace those with common shares or share capital. If the corporation wants to entice the bondholders to convert their bonds, they add an additional sweetener, and that inducement is allocated between debt and equity using a method consistent with how the instrument was first recorded. So in our case, we use the incremental method. We would use the same method to allocate them here. So we assume the bond corp offers an additional 15,000 sweetener when carrying the amount of the debt is the carrying amount is 972,476, which is slightly different from the example that we had before. 985,942 is what it was before. 972,476 is the carrying amount, so that has to go away. The bond's fair value at the date of conversion is 981,462, and so there's a debt retirement cost, essentially a loss on the redemption of the bonds for 8,986, the difference between the fair value and the carrying amount of the debt. So basically we're repricing the bonds to the net amount of the fair value. So the bonds payable goes down by 972. We record a loss on the redemption of the bonds of 8,986. The conversion rights go away. 75,939 was the amount that we originally set up. And the common shares are valued at 1048,415, and the amount of cash we have to pay for the sweetener is 15,000. The retained earnings is debited for the difference between the 15,000 and the debt retirement cost of 89.86. So the loss, of course, will be closed to retained earnings as well after this year, but the loss actually shows up on the income statement. The retained earnings reduction is essentially like an unintentional dividend paid out to reduce the bond obligation. So the new amount of the common shares is the balancing figure. It's basically a plug to make all of this balance at 1,048,415. Normal retirement, if we just waited till the very end, it would be the same as the debt retirement that we did in Chapter 14 for non-convertible bonds, and the equity component, the contributed surplus for the option to convert, would remain in equity as contributed surplus. And all of the bonds payable items would go away. If we retired it early, we'd get rid of the bonds payable. We no longer have any of the obligations, so all of that has to go away. The conversion rights would also be gone, so they would have to be zeroed out as well, and there would be a loss on early retirement, and it would be allocated between the debt and equity portion, just like we did with the conversion a couple of slides forward here, essentially this one. Okay, so we assume that Bond Corp decides to retire the convertible debt early, offers the bondholders $1,070,000 in cash to allow them to retire early, so the cash goes down by 1,000 or 1,070,000. The bonds payable are 972,476 as per our assumption. The debt retirement expense, the difference between the 15,000 and the, how is that? Not quite sure why that shows up again. I think that's not correct. I can see that the contributed surplus should go away, and the bonds payable should be at our assumed carrying amount. So this is that's the carrying amount of the bond. I think this journal entry is actually incorrect. The bonds payable definitely has to go away, and the contributed surplus definitely has to go away. But I think the difference between these would be essentially a loss. So a loss on the early retirement of the bond. So I don't see a reason for the expense treatment. That expense treatment was related to the $15,000 that we paid earlier. So I don't think it actually applies any longer. So I think the key things to take from this journal entry would be bonds payable goes away, contributed surplus conversion rights go away, and the amount of cash paid is offset by a loss on debt retirement in this case to balance. All right. Some of the other examples of some of the other things that I talked about in terms of hybrid instruments. One of them was a term preferred share, which is the mandatorily redeemable preferred shares. That would be presented as an obligation, a liability of the company. Any related dividends would be recorded as interest expense. If we treated the preferred shares as a liability, that means that essentially the interest, the dividend payments that we were making would be recorded as interest expense if we actually treated them as a liability. So even though we're calling them dividends, the economic reality says that these are actually interest expense and should be charged to the income statement. They'll get into retained earnings in a bit, but they don't get charged in the statement of changes in equity. They would be charged through the income statement if we actually did treat those term preferred shares as a liability. So the key thing is you look at the economic substance of the underlying financial instrument. If you treated it as a liability, the payment of the obligation, the payment of the regular return on that, the cost of capital, the payment of the cost of capital would be treated as consistent with the underlying instrument. So equity instruments would be treated as dividends. Payments on debt instruments would be treated as interest expense. Okay. Share-based compensation. And this refers to the fact that in order to align the incentives between the owners of the company and the managers of the company, we often give them compensation which is based on the price, the share capital. So they'll work harder to increase the share capital, which is good. The share price. Managers will work hard to increase the share price if they are owners of the shares or if they have the right to compensation received as shares. So we need to be able to account for that. So these stock compensation plans are used to compensate employees or managers for the services provided, and so as a result we have to account for the fact that that results in a benefit for us. Employees actually work for us, and so that work has some value. We need to record that as a cost of doing business. So recently there's been extensive growth in the use of stock option plans by employers in an attempt to develop company loyalty in both executives and employees. An effective way to accomplish this goal is to give the employees an equity interest. Easy for me to say. An effective way to accomplish this goal is to give the employees an equity interest based on changes in long-term measures such as increases in earnings per share, revenues, share price, market share. We want them to do those things because they're going to increase the share value, and so we're interested in maximizing the value of the shares. That's our sort of stated objective. So we want managers to do those things. So those plans can come in many different forms. Usually what they do is they provide the executive with the opportunity to receive either shares or cash based on share prices, and they'll receive that cash sometime in the future if the company's performance is satisfactory. So stock-based compensation plans help the companies conserve cash, and they often use it to obtain financing from their employees when the employees actually exercise the rights. So there's a price that they have to pay, so they do have to pay the exercise price, so there is some additional financing that's received. 4 common kinds of stock compensation plans are compensatory or employee stock option plans. They give employees or management the opportunity to own part of the company. So employee stock option plans are often called ESOPs, ESOP, employee stock option plan. Management is usually compensatory stock option plan, so that would be a CSOP. So that's for management, and they give the employees or management an opportunity to own part of the company, usually for a reduced price. You can actually give them stock, so you can actually issue stock to your managers. You can use stock appreciation rights. That's actually covered in Appendix 16B. Essentially, it gives you the right to the change in value, so they give you a cash compensation based on the change in the price of the shares, or other performance type plans based on measures such as EPS, earnings per share, revenue, those sorts of things which they want to encourage management to do. The main difference between ESOPs and CSOPs, between employee stock option plans and compensatory stock option plans, is that in the ESOP, the employee pays for the options either fully or partially, and in the CSOP, the management compensatory stock option plans, they don't. So for the ESOPs, these transactions are seen as capital transactions because the company is actually receiving an investment from the employee. So the employee is investing in the company. CSOPs, compensatory stock option plans for management, are primarily seen as a way to compensate the manager for their services. So like a barter transaction, they're getting part of their transaction are part of their compensation through the stock option. And so these services, the services of management, are rendered in managing the company. So the services are rendered by the employees in the act of producing revenues, and so these transactions are seen as operating transactions, and they're recognized in the income statement. So for managers, compensation stock option plans are basically an incentive to get them to produce revenues. So if they're producing revenues, they represent an expense, they should be matched, and so they're treated as operating expenses in the income statement. Under an employee stock option plan, when an option or share right is sold to an employee, the cash account is debited because they get cash. A contributed surplus account is credited for the amount of the premium, so essentially the cost of the option. And when the right or option is exercised, the cash account is again debited for the exercise price, along with a contributed surplus account, and the common share account is credited to reflect the issuance of the shares. I think we have an example here. So as I said, types of compensation plans: CSOPs, compensatory stock option plans. Direct awards of stock are when you actually give them shares. Stock appreciation rights, SARs, are treated in Appendix 16B. You pay them cash on the basis of the stock price appreciation or other performance type plans. Stock options, there are some that are issued by the company. CSOPs, ESOPs would be an example. You have to be an employee to hold them, so they have restrictions other than regular stock options. If they issue stock options to the market, they often are exchanged. They often traded on an exchange. So, for example, options and warrants that are this listing here, those would be exchange traded, and so those would be derivative instruments, and we've talked about those earlier in the class. ESOPs and CSOPs are based on your employment with the company, so they would not be traded on an exchange because you have to be an employee. Other kinds of options which are issued by the company would not be traded on the exchange if their rights are not transferable between different owners. So if they're compensatory in any way, you can't exchange them on the exchange. So the treatment of options and warrants which are issued either by the company or by other financial institutions with the stock of the company being the underlying security, those are exchange traded and would be valued according to that value. Okay. Okay, so in terms of accounting treatment, as we said, compensatory stock option plans are treated as operating transactions. Essentially, they must be measured at fair value. So the total compensation expense is calculated based on the fair value of the options expected to vest on the date the options are granted to the employee. So vesting is when they actually get the right to use them. That may not be allowed until they actually retire with the company. The grant date is the date the employee and the company agree on the value of what's to be exchanged, and so fair value can be estimated using an option pricing model such as the Black-Scholes model. It may be adjusted for some of the unique factors of employee stock options, but essentially we're trying to arrive at a fair value measure, and that's recognized as an expense in the periods when the employee performs the service. A non-compensatory ESOP, just because you're an employee of the company, you have the right to buy shares, and so my mother-in-law has shares that she got from TELUS based on an ESOP style compensation package. Basically, these are treated as capital transactions because you're buying new equity, and so the price that you paid for the equity is essentially credited to the share capital account. So if the stock options under a CSOP are not exercised before their expiration date, the balance in the contributed surplus account related to them would remain. There would be no adjustment. Basically just stays there and belongs to the existing shareholders. If a stock option is forfeited because the company because the employee leaves the company, so they actually haven't fulfilled the terms of vesting, then the estimate of the compensation expense would be adjusted and contributed surplus would be debited for that amount, and so you would adjust for the value at the time of the obligation no longer being there. ASPE allows you to make a choice to estimate forfeitures up front or to account for them as they occur, whereas IFRS requires treatment only when the stock option is actually forfeited. Required disclosure for compensation plans includes the relevant pieces of information, and so let's go back to that in a second. Now let's go back to the disclosure in a bit. So compensatory versus non-compensatory plans, factors to determine whether it's compensatory or just an ESOP, the option terms. If there are non-standard terms, that implies that there's a negotiation process. So that would imply that it's a compensatory plan. It's not similar to other options. It's not just an employee purchase. It would be a negotiated settlement with the terms established by the parties of the transaction. So if there are non-standard terms, for example, if there is a limited amount of vesting for a certain number of periods, then that would be a compensatory plan. If there's a discount from the market price, it implies that it's compensatory. So if only a certain group of employees are eligible to receive the stock option, then it's usually management, and so then it would actually be a compensatory plan as opposed to a generally available employee stock option plan. For ESOPs, they generally have a maximum amount that they're allowed, and that may differ between different classes of employees, but essentially the same terms for all of them. So let's imagine that FANCO set up an ESOP, which is a non-compensatory one. Gives employees the option to purchase shares for $10 a share, and on January the 1st, employees purchased 6,000 options for $6,000, and so that was the premium. We got cash of $6,000, and the contributed surplus options account goes up by $6,000. Haven't actually bought any shares yet, so this is just contributed surplus. So if all of the employees exercise all of their options, then we're going to get another $60,000 in cash. The contributed surplus for the options goes away because it's no longer available, but common shares would go up by $66,000, the value of the cash for the premium and the cash for the actual issue of the shares. For compensatory stock option plans, two accounting issues have to be determined. One is the determination of the compensation expense and the allocation of the compensation expense over a period. So key dates, the work start date, so when you actually started working in the role where you were entitled to the compensatory stock option plan, the CSOP. The grant date is when you get the option. The vesting date is when the employee actually has the right to exercise the options. So often you have to stay for a certain period of time. It may even be till retirement, but the vesting date is established. That's the date that you can first exercise the option. The exercise date when you actually exercise the option, and the expiration date when they expire unexercised. So if the price is too high, higher than the market price, for example, they wouldn't exercise it. It's essentially a call option. Compensation expense is determined as of the measurement date, and so each relevant balance sheet date, for example, would be a measurement date, and it's allocated over the service period. The service period is the period benefited by the employee's service, which is being compensated with the CSOP, and it's usually the period between the grant date and the vesting date. So on November the 1st, Chen Corporation approved a plan to grant 5 executives options to purchase 2,000 shares each. The options are granted on January the 1st, 2018. Option price is $60 per share. The fair value, determined by an option pricing model, results in compensation expense of $220,000. So presumably there's, as we talked about before, there's the intrinsic value plus the time value. That works out to $220,000. And the actual calculation would be beyond the scope of this course, thankfully, I suppose. And so we assume the expected period of service is 2 years, so the journal entry for 2018 and 2019 would be the same. Compensation expense would be half of this option value, $110,000 each, and the contributed surplus stock options account would go up by $210,000 each of the 2 years. So if 20% or 2,000 of the options were actually exercised on June the 1st, 2021, which is 2 years after they were vested, we would get another additional cash payment of $60 for each of the 2,000 shares or 2,000 options. $120,000 would be the additional purchase. The contributed surplus stock options would go down proportionately. So there were, let me see, there were 2,000 shares. The options, we issued options, we granted options to purchase 2,000 shares, and okay. Oh, there's 5 executive options. 5 executives each have 2,000 shares under option. So the total is 5 times 2,000, 10,000. So of the 10,000, only 2,000 are exercised. So the journal entry is to increase cash for the exercise price, reduce the contributed surplus by 20%. So 2,000 of the 10,000 available were exercised. So 20% of the 220,000 goes away and goes into the common shares account. So if the remaining stock options are never exercised, the journal entry would be to make the contributed surplus for stock options would go away, and we would put it into a different account called contributed surplus expired options, because we no longer have an obligation to issue shares at a preferential price in the future. So basically we just changed the name of the account. For direct awards of stock, if you just give them shares, it's a non-monetary reciprocal transaction. There's no cash involved. It's a two-way transaction. The company gives up the shares and they get the employees' services in return. So the fair value of the shares would be recorded as the value of the services, so compensation expense. And so the debit would be compensation expense, the credit would be share capital. Required disclosure of compensation plans. You'd need to describe what account policy was used, the description of the actual plans, any modifications that you had made, all of the things that are listed here. The number and values of options issued, exercised, forfeited, and expired, so you can keep track of the potential dilution of your ownership interest. Description of any assumptions or methods used in determining the fair values, so they'd have to tell you how they arrived at that option value of 220,000 in the previous example. The total compensation cost included in net income contributed surplus for these options, these compensation plans, and anything else that's relevant or helpful in disclosing full disclosure. There's a number of projects that are expected to be on the go. You can see text illustration 16-12 to compare IFRS and ASPE on the different complex financial instruments. So that's illustration 16-12. Standards are basically similar, except for that ASPE allows the option to measure the equity component of compound instruments at 0, so they put it all into debt, or to measure the component most easily measured first and apply the residual value to the other component. IFRS essentially requires the debt component be measured first, with any residual value being assigned to equity. Looking ahead, there are some changes to the hedge accounting project. It's been split into 2 phases. There's a general hedge accounting and a macro hedge accounting phase. Macro hedging refers to hedging based on a portfolio of financial instruments such as investments, and so it's going to be treated differently than the general hedge accounting portion. Guidance relating to a general hedge accounting has already been issued. It's incorporated into IFRS 9, as we talked about before, and also into this chapter in the Appendix 16A. The Accounting Standards Board issued an exposure draft in 2014 entitled Redeemable Preferred Shares, issued in a tax planning arrangement. So if you're interested in that, the Accounting Standards Board was deliberating the issues related to this type of preferred share when the text went to print. So it may or may not have been completed. And that's all there is to Chapter 16. Thanks for listening. Bye.